Hello, everyone. Welcome to this trade management mini session. My name is Barbara Armstrong, and today we're going to talk about something I call wash, rinse, repeat, which occurs when we have done several trades on the same stock. And they aren't always exactly the same trade, but we're kind of looking at and trying to take advantage of trend. And so we're looking at several trades that were placed on the same stock, which we happen to notice in our trading a smaller account class. The example we're looking at today is Goldman Sachs, and a number of trades placed from April 4th to May 12th in our example trading account. Now, keep in mind that all of these trades that we're looking at today are options trades. Options carry a high level of risk and aren't suitable for all investors. All of these trades were placed on the paper money software application on the thinkorswim desktop platform. One of the differences between that and a live account is that short positions will never be assigned early in paper money. That can happen in a live account. Okay, let's get out and have a look at the platform. And we'll start with the chart. So the first trade was placed on April 12th. It was a short call vertical, which is a bearish to neutral trade. And then when we closed out of that trade, the next trade wasn't placed until May 7th. But then in pretty quick succession, we placed a long call vertical and short put vertical on the 7th and the 9th. And then on the 12th, we did another short put vertical. And we're now out of all of those positions. Okay, and how does it look? Well, this is what it looks like. And that can be kind of confusing to sort out. So I went ahead and did all the math for these examples. But just to kind of group them, kind of lead the eye, let me just circle these like this. Okay, so, on the 4th, we placed our short call vertical trade, and we ended up out of that on the 8th. On the 7th, we placed both a short put vertical and a long call vertical trade, and we ended up out of those fairly quickly. And then on the 9th, we placed another short put vertical and another long call vertical trade, both bullish, and we ended up out of those relatively quickly. And then on the 12th, we placed another short put vertical trade, and that hit our target to get out at 80% of our max gain today, which is the 16th of May. And so if we come and look at these, the first one was on the 4th, and that was our bearish to neutral trade where we got in for $1.25. We were paid $1.25 to get in. We took our risk off the table by buying it back when it was worth 20 cents. So you'll see the $1.25 minus the 20, which means we had a net gain of $1.05 a share. We did one contract, which we can see here. And so our total gain was $105. Now I've just taken transaction fees. I calculated that in one lump sum at the end. They aren't in these individual calculations. And then the way we would calculate our return on risk is to take that net gain of $1.05 a share and divide it by our risk. And what were we risking? Well, the difference between the strikes, $5, minus what we were paid to get into the trade, $5 minus the $1.35. And so that came out to $5, minus $1.25 on this first example. That came out to 28%. Now on the 7th, we placed another trade. In fact, we placed two trades, a short put vertical and a long call vertical, both bullish. And when we look at the short put vertical, it looks kind of similar to the short call vertical, doesn't it? We were paid $1.35 to get in. We bought it back for 25 cents. Total gain, $110. Our return on risk, 30%. Now with the long call vertical, the risk is a little different. The risk is, what we paid to get into the trade. And typically in this class, we have aimed for a 50% return on our risk, but we decided to lower our sights a bit and put in a target that represented a 25% return on our risk. And our net gain on that was $70 or 70 cents a share. We had 2 contracts, so we were, ended up with a net gain of $140, which represented a return on risk of 24%. So just shy of the 25% that we were aiming for. Now on May 9th, we were out of the last 2 trades. And so we did another short put vertical, kind of wash, rinse, repeat, and another long call vertical. And again, you can see the similarities here. Our short put vertical here, we were paid $1.10 to get in. We bought it back for 20 cents a few days later. And our net gain on that was 90 or a 23% return. With the long call vertical, we were risking 265, which is what we paid when we got in. We got out for 340. And again, this time we were putting in more modest targets, and, we got out with a 28% return. Now, if you look at our example trading plan, our goal in the past has been a 50% return, and we may go back to that. But an example trading plan is just that, and you can change it as appropriate for you. Then the last one in this group we placed on the 12th. It was a short put vertical. So we can see here's our put vertical and here's our strikes. We paid $1. We were paid $1.35 to get in, and then we bought it back when we had 80% of our max gain at 26. So there's our $1.35 minus 26, our gain of $109. And then with these, you're back to your risk is the $5 minus what you were paid when you got in. So a 30% return. So you can see here with the long call verticals and the short put verticals, the returns were more similar than they've been in the past, in that with the verticals in the past, we've typically aimed for a 50% return. And we lowered our sights a bit, so to speak, in these example trades. But the total gain was $704. And this doesn't take transaction fees into account. But, we had in total 28 individual contract legs. It was 7 trades, and we had to pay $1.30 per contract to get into each one, and we paid $1.30 for each contract to close out the trade. So in total, the transaction fees, which I put at the bottom here, came to $18.20. And so, that would come off the $704, just as an example. Now, these trades all happened to work out. We also closed a couple of trades on Tesla that didn't work out, but we haven't traded as often on Tesla as we had on Goldman Sachs. And so I hope you found this session helpful. I know a lot of you were interested in seeing the numbers, and again, these are just example trades. We'll see if we continue to add to our example trades, in the future. And these, I could end up doing one with a wash, rinse, repeat where we kept getting hammered, and that has happened too. So, that's why position sizing is so important, and watching your positions once you get in. So guys, take care. Thanks for joining me, and we'll see you in a webcast coming up soon. Take care.